Hello everyone, myself Thakkar Mrudit Ajay Kumar studying in FYBCom. Today I am going to present a short presentation on the concept of consistency. Now let us begin with the definition of consistency. Consistency is required while recording a certain type of transaction in the books of accounts. That implies that years after years, uniform rules and methods should be followed to record transaction. Say for example, if a stock is valued on the basis of cost price or market price, whichever is lower, this method once adopted should not be changed. A method once adopted should be followed years after years. This will facilitate comparison of accounts of different years and useful conclusions and predictions can be drawn. This, of course, does not mean that a particular method adopted in the past cannot be changed at all. Necessary changes can be made if the need arises, but the impact of such change on the reporting and presentation of business income and financial position must be clarified in the books of accounts. For example, so far depreciation has been charged under straight line method and now it is charged as per reducing balance method. The impact of such change on the profit of the business and its balance sheet should be clearly revealed. So you must be wondering what is inconsistency. Let me give you some examples of inconsistency. If plant and machinery is shown at their original cost but they are depreciated as per the replacement cost method, this is called inconsistency. While evaluating stock, if certain items of stock are valued as per FIFO method while some other items of stock are valued as per LIFO method, then again this is called inconsistency. It is only when there are two or more alternatives regarding an accounting matter that the question of consistency arises. For example, there are so many methods of calculating depreciation. Now, out of straight line method and reducing balance method, if straight line method is adopted, every year depreciation should be charged under the same method. Secondly, the point to notice is that over the years the stock is valued under different methods, but even then there is consistency in it because it is based on accounting principle. Say for example, stock is conventionally valued on the basis of cost price or market price, whichever is lower. In 2019, it was valued at its market value because its market value was lower than the cost, and in 2020 it is valued at its cost price because its cost price was less than its market value. Here there is consistency. The stock was valued differently for both the years, but the accounting policy remains uniform and hence consistency is not breached. As Hendrickson writes, the doctrine of consistency has been a basic tenet in accounting for many years. It has been used to refer to the use of the same accounting procedures by a single firm or accounting entity from period to period. The use of similar measurement, concept, and procedure for related items within the statements of a firm for a single period, and the use of the same procedures by different firms. If different procedures and methods are used for evaluation and measurement, it becomes difficult to project future trends as also to know the impact of external factors on the firm. For example, changes in financial circumstances or impact of actions of rival firms. If different methods are used over the years, the users of the financial statements will find it difficult to understand the impact of changes in the accounting procedures and the changes in the internal and external environment. And as a result, it is difficult for them to draw the reliable conclusions. For example, if assets are shown at their cost price for 1 year and then at the replacement cost in the second year, the changes in the method for different years will yield abnormal trends and hence it becomes difficult to draw conclusions. So, this is as far as the concept of consistency is concerned. Thank you.